So now here's some useful data we want to pay attention to, because this data can help us understand, oh wow, this is when a really big inflection point could happen. And you want to mark your calendar for this one, because this is a big deal. And the Fed is paying close attention to this particular metric. Before we talk about this metric though, let's talk about some things that relate to it, like Dollar Tree, suffering so bad in the last quarter of earnings that they're actually now resorting to discounting at the dollar store. They're seeing so much theft on top of that now it makes you wonder if people are going to start stealing from the dollar store more than they're already stealing from Target. Target already facing $400 million in theft amid also declines in revenues. Nordstrom sales down substantially. Digital sales down over 16%. Factor in inflation, you're down over 24%. At Nordstrom for digital sales. And in-store sales, also not looking too pretty. Some companies are reporting decently, but don't look to HP, who's now firing 10% of their workforce on not only slow PC sales, but PC sales that are so slow they actually think the weakness is going to extend into 2023. That's kind of what Dell told us yesterday as well. It even goes to real estate agents, with, we know, 80% of which, just like most consumers, 80% of which are living paycheck to paycheck. Now all of a sudden, because real estate transactions are starting to dry up, 37% of real estate agents can't pay their office rent. 37%, that's 1 in 3 real estate agents can't pay their rent. And the amount of people pulling money out of their 401ks for hardship withdrawals is now up 24%. Now those hardship withdrawals are still relatively low, but we see an inflection point. Nike is discounting like crazy, and sure, some smaller brands with pricing power, companies like Enphase or Lulu, are just absolutely killing it and they're crushing it. And they probably still will, since they're small companies getting larger. But what you're not seeing, folks, is the Fed U-turning yet. Until potentially a U-turn in this data that's starting to have a massive shift. Fed talked about it briefly this morning, but almost nobody touched on it. But that's okay. I'm here and I'm gonna break it down. But you have to remember, when the Fed pays attention to it, it doesn't mean they're going to react super fast. So you want to mark your calendar for this data. We're going to talk about this data. But there's something very exciting right before that data, and that's the 60% off coupon code on the programs on maximizing your wealth in 2023. 2023 could be the best year to explode your wealth and your net worth with real estate. I think there are going to be massive real estate opportunities, and I've got a phenomenal program on going from zero to millionaire in real estate for you. Link down below. And now 60% off, the biggest coupon code we've ever had, is here now for Black Friday. Going into 2023 could also be a great trading opportunity, especially with my $5 million trading challenge. With every single trade I make transparently posted. If I win, I lose, I will give you my thesis and my trades. If you come for the thesis or come to do the opposite or whatever you want to do, you will have the information backing my decisions and my opinions. Check that out in the Stocks and Psychology of Money group. 2023 could also be a great year to start a side hustle or get promoted at your job with our Elite Hustlers University course. Take a peek at that, along with any of the other programs linked down below. If you'd like a custom bundle, email us at kevin@meetkevin.com, that we do have some bundles on the website linked down below. So, what did the Fed tell us? The Fed, Esther George, had the following to say today, quote, "The dynamics of excess savings are going to be a key factor for the economic outlook. If consumer spending stays strong due to high savings, then rates might have to go higher. We already know that. When terminal Fed funds rates go up, the stock market go down. Not great." Well, Esther George, who's very concerned about consumers and consumer spending, I have some phenomenal news for you about the complete wipeout of excess consumer savings that's happening. Let's take a look at some charts. First, the savings rate for individuals during the pandemic was 33%. Now it's at an all-time low, 3.1%. And when the savings rate plummets, it also tends to align with a plummet of excess income characterized by disposable income charts. This is a chart showing you disposable income. And what you really want to look at is the fact that we have just gone negative, my friends. Look down here at this little green section here. Let's go ahead and go in deep here. Look at that. We have finally gone negative. You can barely see it right there, but we finally gone negative. And this is Excellent, because it is finally an end to this insane growth of disposable income growth, which if you have less money that's disposable, meaning you could spend it on stuff, and you're now saving less money than you were before the pandemic, savings rates today being at 3.1% are well below what we saw before the pandemic. Not only are you saving less money, but you have less money to spend. Guess what happens? Spending tends to roll over. But it's not just spending that tends to roll over. We know that people are borrowing more money to sustain some of their savings or sustain some of their spending. But what metrics, when we just look at credit borrowing and we see credit borrowing explode, what those metrics miss is this right here. US households are paying off debt at the highest annual level ever. Well, actually, with the exception of that tiny little peak right there. With the exception of that, we are at now, and that was during the pandemic when people were like, oh my gosh, pay everything off, right? And then we got like big stimmy payments and stuff like that. But other than that, household debt repayments are really high right now. People are paying off credit cards. They're getting out of debt, which is a smart thing to do. Especially, this is like so critical. Look, if you want to buy a house, you want to get into multifamily real estate, you got to pay off your debt. Get out of debt so you can maximize your qualifying ability by minimizing your debt to income ratio. Obviously, stuff we talk about in the Zero to Millionaire course for real estate investing. Go into all, if you're confused by anything about real estate investing, tenants, property management, renovations, just learn from somebody who's done real estate for a very, very long time, with a family who's done real estate for a very, very long time, and we're really good at what we do. That's why we're launching a real estate startup that's going to start buying like crazy in 2023. That's the expectation right now. So very, very exciting. But anyway, these debt repayments are huge because they're signaling that not only do consumers have less money coming in for savings or spending, but the money that they do have, they're now dumping into debt payoff, which is really, really interesting because those two things combined mean less consumer spending. And come March to April of 2023, we expect to have year-over-year negative real estate appreciation. Even though real estate prices are already down 8 to 12% off their Q1, Q2 peak, depending on where you are, you actually still have year-over-year growth in home prices. That means home prices went kind of like this, and they've started coming down. But when you compare year-over-year, they're still at a higher level today. But we expect that to be negative when we get to March to May. So come Q2 of 2023, you're going to be in a situation where excess savings are plummeting, debt payoff is skyrocketing, and people are realizing that household balance sheets are actually starting to look worse because real estate equity is starting to shrink. And Robert Shiller, who is famous for the Case-Shiller Index and a Princeton economist, has told us that it's not stocks going down that tends to lead people to spend less money. It's real estate going down that leads people to spend less money. So combine these three things, you've got a setup for something very, very beautiful. It's this. Now I'm going to explain this. But I want you to think about those three things quickly because I want you to remember these three things. Number one, we talked about this, is real estate equity leads consumption to go down. But number two, having less money leads consumption to go down. And number three, increasing debt, we'll put it down, debt payoff leads consumption to go down. Consumption going down, 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 down is a big deal because that's what the Fed is looking for. And all of these things are pointing to consumption going down. But as of Q2 of 2022, that's this summer, we were still sitting at about $1.7 trillion of excess savings. I realize it says billions, but it's in thousands. So I'm translating it for you. Just like that 60% off coupon code is translated to a really good deal. But anyway, what's fascinating about this is the following. Watch this. We're going to erase this. I want you to see this. See here in 2021, when the stimmy payments stopped, you kind of had a slow decline here in excess savings, right? Well, what would you call this right here in Q4 of 2021, Q4 of last year? Well, friends, this is an inflection point. An inflection point is when all of a sudden the rate of decline actually accelerates. And it not only accelerated here, it accelerated here with a minor acceleration again. And so we could actually see this line again inflect down to fall even faster. But before we think about this line and speculate about this line falling faster, let's just consider this. By Q4 of 2021, we were sitting at about $2.2 trillion, $2.3 trillion of excess savings. That leads to a decline of about $250 to $300 billion of excess savings per quarter. But this chart only goes to Q2, which if the chart only goes to Q2, then we probably have another $600 billion of excess savings that have already been evaporated off of this, which means we could already be sitting right here at $1.1 trillion of excess savings. And that means when we go into Q1, Q2, by Q3, somewhere between Q2 and Q3, assuming the excess savings don't evaporate even faster, excuse me, which is possible, somewhere between Q2 and Q3 of 2023, excess savings will be zero. That's the expectation right now. Now, why is that bad? Well, if excess savings go to zero and start going negative, then people are going to look at their bank accounts and go, oh my gosh, we have less money in 2023 than we had in 2019. You can see this chart is an excess savings chart back to 2020. That's insane. At the same time, we expect inflation will still be high, not on a month over month or annual basis where we're looking at the change in CPI, but prices could remain high. Consider this. Dell in their earnings report told us, actually in their earnings call, told us that, hey, we are actually starting to see disinflation. Component prices are coming down. This is why we saw a softening PPI report. So does that mean computers are going to become cheaper? Dell said no. Even though demand has been weak, they don't actually expect to reduce the price of their PCs. They want to hold the price of their PCs high. And as prices come down for the components, more profit margin. Consumers still spending at high levels or having to spend at high prices, elevated prices. Now, combine all of this together. Excess savings going to zero, pain in real estate, no disposable income, right? All of these things, the debt payoff, all of these things combined. And what you have is probably a Q3 of no money left. No money left by Q3 2020. But the Fed realizes that their policy tends to operate with a 6 to 9 month lag. That means those high interest rates really take about 6 to 9 months to really get through the economy and hit consumers. With the exception of the stock market, it hits the stock market faster. This is why generally stocks lead us out of a recession. They also lead us into a recession when things fall, right? Anyway, 6 to 9 months of a lag would actually suggest that the Fed needs to peak out their hawking between now-ish to January, maybe to March. So by now, we're really talking about December, Jan, or March. So sometime within the next 4 months, we think the Fed has to flip. And they're going to flip big if these consumer excess savings numbers continue down this trajectory and that debt payoff continues to be high. Because if these numbers go negative, combined with high prices, bye-bye spending. And then you could have real pain in 2023 where you actually potentially start knocking on the door of a depression, which the Federal Reserve does not want to push us into a depression. They are forcing a recession to get rid of inflation or potentially near recession, but they don't want to push us into a depression, which means my expectations are the Fed is very, 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 very likely to flip within the next 4 months. If we get a soft CPI report in December, they could flip even sooner. That is very bullish. I'm very excited about what the future holds. I'm very excited about my $5 million trading competition starting Monday. And I'm super excited to see you as a course member where you get lifetime access to all of our content. We'll be having new lectures coming out specifically for 2023 real estate. We'll have updates for the property management course as well. We'll also have updates to fundamental analysis and balance sheet, cash flow statement, and income statement analysis in the Stocks and Psychology of Money group. And of course, the full launch of the Elite Hustlers University on Friday. Thanks so much for watching. Check out the programs linked down below on building your wealth. And folks, we'll see you in the next one. Goodbye.